Crystal Portfolio Planning is to bring conversations around money right to you at your fingertips through your screen. And we want to talk about a variety of topics with some special experts that know their craft, their specialty. So you don't need to go surfing the internet trying to find out what's true, what's not true. We do the vetting, we have the conversations, and we bring it right to you. So today we're going to be talking about very specific real estate investment heavy conversations. And really, we're coming right off the tail end of the elections in the States. We're shooting this on November 6th, 2024. So I just saw the results of everything in the States, and then the interest rates have been dropping. So if history is a indicator, it looks like investments will probably go up and there'll be more money circling in the economy. So what do you do with that, and how do you make real estate a part of your overall investment portfolio? But first off, I want to introduce the people that we have with us today. So myself, obviously, I'm Michelle. You probably see me, unfortunately, every single week. Tyson, same thing. And then we are very, very grateful to have Mike from the Home Happy team join us straight off a podcast episode from Penticton. I think that you were just there. Now you're back in Kelowna.
Yeah, back in Kelowna.
Man, when you drive a car that fast, you can bump around the Okanagan so quick, right?
Yeah.
Uh, awesome. Let's jump right into it, guys. Real estate is it's one of those things that is always a hot topic when it comes to Canada, especially on the coast, like BC, Ontario. There are always goals that are very, very hard to reach. So people either love real estate, hate real estate, or think it's totally, unachievable for the majority of people. So let's talk real estate as a wealth building tool. What are your guys' thoughts? What are your guys' opinions? Tyson, if you want to lead us off, and then we'll go to Mike.
Yeah. Well, we're based in the Greater Vancouver area of Chalanite, and so every other client that we bump into is a real estate investor in some capacity, and or they want to be. And it's interesting because the historical values of property in the Greater Vancouver area have just skyrocketed, especially over the last 20 years. Um, we haven't seen a property recession in this area for probably 35 years, maybe more. Um, and so I don't know if that means that if we're due or not, but it's pretty unrealistic to buy an investment that's always going to go up. And then you just wonder, like, when does the train slow down, or when do you get on, when do you get off? And so, in terms of the clients that we see, yeah, everybody's invested in real estate pretty much, and they feel great about it because it's never let them down. And I don't know if that's a great way to categorize an investment because there's usually ups and downs.
Yeah, it's I mean, from a historical point of view, um, basically Expo 86 kind of opened the world view to Vancouver, and ever since then we've kind of been on a not always up, but jagged kind of upward trajectory. And I know that in when was brokering in 1999, that the average mortgage balance was 125,000, and now our average is about 550 or somewhere around there. And mine's a little skewed because I deal with a lot of past clients that come back on renewal. So if you're strictly dealing with first-time buyers, you're probably at $1 million as an average mortgage balance. So
That's right.
yeah, it's not guaranteed to go up. It seems like it is, but it's not. Nothing is. And we do see slowdowns. I mean, 99, 2000 was actually a slower era, and it was pretty flat through the 90s. But since that era, I really haven't. And we had a little bit of slowdown 2007, 2008, but it just keeps kind of moving upwards. And I don't think that means it's the perfect investment, but I do think that it should be something in your portfolio if you're going to build a proper portfolio. And it doesn't always mean you have to go and buy something. It could mean investment. It could mean using real estate in different forms. We'll get more into that, I think, in this discussion. But in general, it's always good investment. I think sadly the government has put a lot more rules and regulations on things since about 2016, and the more I'm not a big believer in government controlling things. I think they just screw things up more than they fix. And for every rule they make, it helps one person, but five others get screwed. So it's one of those things. We have to deal with the regulations. We have to look at it. I mean, if you're going to buy an investment property to rent out, there's rent control in BC, and we have to be aware of that. So there's lots to it. Obviously, it's complex, but that's why having the right circle of experts around you to give you the right advice can be so helpful. But I do think as a young professional getting started, it's got to be something that you're thinking about. You certainly want to buy your residence, and you certainly should think about buying your office space, because those are both, you need to have a place to live, you need a place to work usually. And if you can buy your business spot, you've got a guaranteed renter, and it's, instead of you paying money out to rent, you're paying it to yourself. So those are two automatics to me. And then after that, it's what do you do with the money in your company, and how do you use that to better yourself? And that's what we're here to talk about.
Yeah, I think when it comes to planning, we talk about tax planning, and some people, when they hear tax planning, they think it's like tax avoidance or things like that. Like, oh, we got some strategies to avoid paying tax and get around that. That's never a good idea, because if you're not paying tax, for the most part, you're doing something probably illegal, and you're probably gonna get caught at some point, and then you get penalties and back tax and all that kind of mess that comes with it. Tax planning is essentially just following the Income Tax Act and investing following the Income Tax Act. So if there's things that are tax free, like your TFSA here in Canada, like your primary residence, I think those are important assets to hold, because it's very rare that you can have something that will go up and down and up. But on the long term, it'll end up being higher than it was when you first bought it, and you can capture all those gains tax free, which essentially means all that money is your money. I think that's very rare. But to Mike's point, the purpose of your investment is where the nuances come into play, and depending where you live, it's not as advantageous as it used to be. So, for example, in BC, your tenants have a ton of rules. So, with the cost of housing the way it is now, with the cost of upkeep the way it is now, home insurance is higher, all your bills and utilities are higher. Many people aren't breaking even at all. They're in a deficit on a month-to-month basis, and they're hoping that the value of the property goes up higher, and then that'll make up for the money that they're losing on a month-to-month basis, and they can capitalize on the increase later on, either by doing a home equity line of credit or refinance, or eventually selling it and keeping all that money. That being said, you want to run the numbers, because if you're even marginally making money on a monthly basis, but then you have one bad tenant that it takes you 6 months to evict, and you got to pay $10,000 in what is it, not tariff fees, whatever the costs are that come in and kick people out. It's tough, and that can wipe out like 4 years of gains, or 4 or 5 years of gains on your rental property. So you got to always run. I recommend worst case scenario, like what if this happens? What if this happens? What if this happens? And if it still makes sense, then it's a good investment. If you're just hoping that everything works out well and you got your fingers crossed, it's probably not a good investment, and it doesn't make a lot of sense. And Mike, we talked about this before about pre-sales, people not even planning to close on it. I'll just buy it and flip the contract later on. And then what if somebody doesn't want to buy that? Then you're stuck with it. Then you're trying to find last minute from the co-sign or whatever. So you should always, always, always have a strategy, especially when it is related to real estate, because the prices and the money is so high, especially in BC, especially in Ontario. It's extremely expensive. So as soon as you sign your name on it and you remove subject, you are now liable for buying that property. And if you don't have strategy in place and something bad happens, you're stuck, because you are liable for that money, and you could definitely lose your clothes over it. So it's very important to have a strategy. But yeah, primary residence, like Mike said, is really important. I think that's something that everybody, if it's within your means, should try and work towards. And then if you are a working professional and you're going to be having a commercial space, especially with a private practice, definitely have ownership in your commercial space, because you're going to have that, and then you can refinance that, and debt is not income. So as you refinance it, you pull all that money out, you can do other stuff with it. And there's lots of clients that will buy something and then refinance it, pull the money out tax free, and then pop that into your TFSA or maybe their RSP and get a huge tax return, and then start turning one tax free asset into multiple tax free assets. But just make sure, we keep saying the same thing over and over again, but make sure you have a strategy in place, because that can go upside down really quick on you. And if you don't believe us, ask people in 07 and 08. If you don't believe us, ask people when the interest rates increased. If you don't believe us, ask people during COVID that lost their jobs, or that had tenants lost their jobs and weren't able to make those payments. So there's a lot of things that can happen that can make your real estate investment not an investment and just a huge liability. And if you can't service that debt, then you're in a lot of trouble.
Yeah, well said.
But enough about the doom and gloom. when it comes to real estate, there's obviously buying it is one thing. So, Tyson, what are some ways that professionals, they're starting their career, first, second year, perhaps, what are some ways that they can start to work towards getting that down payment to buy their primary residence in the most tax efficient way?
Mm.
Yeah, so I think for most people, they're familiar with the traditional way where you can build money in your RRSP and use the home buyers plan to pull money out, in which in the last year we've actually increased that. We used to be able to withdraw $35,000. So if it's you and your spouse or you and your partner, that's $70,000 for your down payment. But now they've increased that to $60,000 per person. So your first challenge is getting $60,000 into both of your RRSPs. But then they've also launched the FHSA, the First Home Savers Account. And this is the end of the first full year that we've had it because it launched partway through the last year. So you're allowed to build up to $40,000 in your FHSA, $8,000 per year. And if we're in November now. If you don't own a home and you don't have an FHSA, open one now and throw $100 in. You don't have to fully fund it if you can't. And you will start to accumulate contribution room, but you won't accumulate contribution room until your FHSA is open. And so some of the conversations we've had with families is if you have adult children or adult grandchildren and you want to kind of waterfall some of that wealth down, an FHSA is a great place for you to help them build some savings because they're going to use it to buy a home. And if the grandparent or the parent generation is going to be helping fund the cost of purchasing a home, then this is a way to do it and get some tax relief within the family. And, so you want to be using both. For our clients that are incorporated and don't pull income in a way that's going to generate RRSP room, sometimes we've seen it where clients will do a shareholder loan to themselves, or they'll pay just a little bit of extra income at the end of the year. And November is tax year end for a lot of businesses. So this is the time where you maybe want to pad your income for 2024. And then in January, take a little more income so that your mortgage broker on the Home Happy team can have a little more income to work with and get your approval through the door without as much massaging and stuff that's needed.
Absolutely. Yeah, I think it's a lot of people, like you were saying earlier. I mean, we just think, oh, let's just do whatever it takes just to not pay much tax. Well, that hurts you down the road. And that might be true 10 years ago a little bit, but nowadays, with the changes they've made, it's just they've made the lender's job super hard if you don't show enough income. So um, I think regardless, when you have a corporation set up, you've got to think about strategy, not just how much tax you pay, but what do you want to do in the future? If you show no income, you're not going to be able to borrow anything. So
Yeah.
um, that's really the first step. And then I love the FHSA. I think that thing is like everybody should have one. If you don't own a home, go open one, period. Like
Yep.
regardless, and get that going. RSPs obviously are important for getting the down payment. People should be aware there's RSP catch-up loans that you can go and apply for that they can stretch over 10 years, maybe even longer, especially if you're a professional. So you can have a low payment on it. You can get the money into the RSP right away. And you can use hopefully some money coming back from Revenue Canada if you've paid taxes. You can use that. Plus, you can also use the actual funds that you put into the RSP eventually for a down payment. So, a bunch of little strategies there to help you with down payments. But once you get to that point of actually thinking about buying, say, your residence, be aware as a professional with doctors and medical professionals and dental, we have special programs that are available that you may not show as much income early on when you first get going. These programs allow new professionals to be treated like a experienced professional with more income. So those are very interesting and open some doors, especially when you're first trying to buy a residence. I think everybody should think about real estate from a long-term point of view, not just, oh, I really like the color of the paint. Um, it should be something where, okay, you can afford to buy a condo, then buy that condo, but buy that condo with the thought of, if I buy this condo, but I'm planning to buy a house down the road, is this a condo I can hold on to and rent out? If it's a building where you can't rent it out ever, that's not probably a smart move because you can strategically make that one of your assets and move into your own residence and keep that as a rental property. So big picture thinking is always important. I think if you're going to build long, I mean, you guys know this, I'm not telling you guys anything, but it's just, I think people think too short term sometimes, and they got to think bigger. And that condo can be converted into a rental property, and now the equity that you build in that condo can be used for buying another rental property. And that's the thing. Revenue Canada, CRA, one of the only businesses that they will allow to show a loss over a number of years is real estate investment. So if you have a rental property that on paper you're showing a loss, and most people should try to set it up that way, so you're not taking a lot of money out of your pocket, but it's not making a lot of income either, which is pretty well every rental in BC. It should be structured that way because you can use it, you can finance 100% of that. So you could have, let's say that condo experience, you've lived there, you move out, you buy your place, just keep that part separate. But if that condo goes from 500,000 to 600,000 or 700,000, we can now access the equity, use that for the down payment on the rental property you're buying. And then, so 20% down and then 80% finance, that's 100% financing by using both properties. And now that's a full 100% write-off on all the interest. So there's just little things like that become really interesting. I think there's a really interesting window of opportunity right now with the rule changes in BC where it's all going high density. I think for a lot of people with the right income and the right situation, there's some opportunities coming up. I mean, if you could buy, say, just a regular house, whatever that costs, and rent it out for now, maybe 1-2 suites, that could be a long-term holding property that, eventually you could turn into a 6-unit or 8-unit building on a regular lot. And like, I think that's a great investment where if the current rent covers everything and you're not really putting much into it, but it just keeps doing itself, your plan could be 10-20 years from now, you tear it down, build 6 units, and now you can rent out all 6, or even retire and live in one of them and rent out the other 5. I mean, those are long-term things, but that's why you've got to think long-term. And I think that's an opportunity that's opened up with these changes they've made. So it's kind of interesting.
I think that's a great example of working with a professional team. Is most people only see the thing that they want to purchase, right? Like it's not even the next move because they're not taking into account all of the expenses incurred with conducting that move. But working with a professional team, you could potentially guide them in the next 3, 4, 5 moves, which might be a 10-year play. And clients can't see that stuff because it's like you can't see the forest for the trees. And I think that's just a great example of working with a professional network of advisors that can help you piece together like, hey, maybe this is a great portfolio move for, for your family or for your business. Putting it all together by yourself, you might not be able to see it.
Yeah, and why become an expert in that stuff when you're the expert at what you do? Get the right people around you and just keep doing what you're doing. That's, I mean, you don't go and knit a shirt, you go buy one. That's kind of, what we do. I mean, we want the right people to give us the right advice so we can move on with it and stick to what we do well.
Yeah, I think that's one thing I do really enjoy about working in the professional space is a lot of the people have that mindset. A lot of our physician dentists or accounting clients are of that mindset where, listen, I'm really good at what I do and that's what's going to generate this income, but you're a specialist in the financial planning side, you're a specialist in the lending side. So we'll hand off to you and you guide us, let us know what makes the most sense and why, and then we can move forward. And it's funny because it's the same thing for us. We've talked about this many times before on different podcasts, but we have, myself and Tyson, had zero interest in trying to be mortgage brokers and oh, hey, we can capture more money if we just also start doing mortgages. It's a detriment to our clients because there's no way that we can be even a quarter of the specialist that Mike is with all the years of experience and things that he's seen. So why not just give the best advice to our clients through having a professional? And we do the same thing with the whole circle around us. So I think that's what's really grown our business personally over the last several years is just becoming really good at what we do and getting experts to fill in the gaps. And the same blueprint that we follow professionally is the same blueprint that we give to our clients. And it's been, paying huge dividends as well, because then everyone can move faster and make the moves that need to be made in a more strategic way. So, Mike, you kind of answered our second point already about leveraging mortgages effectively, but I think if there's anything you can add or maybe circle back, because I think the 100% loan to value was part of what you said, but I think there's some power in going back to that and speaking to that specifically about, if you're someone that has a rental property, either owned in the corporation or personally, a rental property, and you want to use that to keep buying more rental property, what does that look like?
Yeah, it's a good topic. Obviously, having a corporation as a professional is a must. Now, it having a holding company to buy the real estate is good and bad. It's not simple. It's like everything else. It's complex. From a lending point of view, it adds a wrinkle to us because lenders don't like it. They want just the person. They don't want the company. So it limits A, who we can go to, and B, a lot of the lenders try to treat it as commercial instead of residential. And guess what that means? They try to make more money. So as much as you're saving money by having a holding company, they want to make money off you because of that holding company. So everybody's situation is individual, but in general, having a big picture and having a plan is the key. We keep drilling that home, but it's so important. But yeah, I've had clients who accumulated a rental property and then we just used the equity as it grew and bought the next one, and then they got used to being landlords, and eventually their plan was to retire with 5 or 6, and we would keep them maxed, as use all the equity we can, obviously for the tax write-off because their income is higher. And then eventually the plan was as they retired and slowed down, they would sell one or maybe two and pay off all the mortgages and now just collect checks. And it's to me, that's a great setup, especially for somebody who doesn't get a pension, who can't count on, a long-term, retirement income from the government or whoever. So yeah, it's a great strategy. It's not the only strategy, but right, yeah. I mean, we can access the equity when you have basically 80% is the number, 80% of the value of your property. That's what we can go and max it out to. We can use that to take that from. For some people, what we do is initially help them pay down their residence because they put money into this. They can take money out of it. That's an accountant's job, but basically pay down the mortgage they can't write off, and then use the equity, set up a line of credit or set up a mortgage on their residence and use that to buy further things, either investments or real estate or whatever. But it's always about trying to get everything in. It's like you said before, we don't want to scam the system. We want to use the system and take advantage of the way it's written, and that's what smart people do. And yeah, it's from a long-term point of view, it's amazing what you can do with the proper advice and using equity. And I know that older generations have a sort of almost obsession with paying their mortgage off. They want everything paid off, and I get why. I mean, they went through bad times where somebody else controlled their residence, and that's not cool. And I get that, but we can go way past that now, and you can control it all and not have to feel like you're losing, you're winning, and using that equity as part of that.
Well said. So, Tyson, the next question would be more so for you then, is that we've heard all the great things when it comes to real estate, individually buying it. So, what I mean individually is like buying this home, buying this condo, buying this townhouse, and owning it. Well, you and the bank technically own it together, but buying it individually. When we talk about real estate versus other investments, like a REIT, like a MIC, what's the difference? What's the difference of why pros and cons of each one? And then I guess I'll preface this by saying a little bit about what a REIT and a MIC is and just my thoughts on it. So when it comes to a REIT, that's a real estate investment trust. And essentially what that does is it allows you, instead of buying one individual property, whether it be commercial or residential, you can buy a group or a portfolio of residential or commercial properties, and all of them have their own kind of specific niches. So some of them will be commercial in a retail commercial, some of them would be medical commercial, some of them could be multifamily homes, and everything between. So when you're looking at a REIT, you want to look at the portfolio breakdown of that REIT and see what properties are being held and what's the loan to value on them, and a lot of due diligence on those. But the cool thing that I like about REITs personally is the fact that if I own something individually, let's say I own a home, yeah, it's undiversified, meaning that all my money is in this one property. And if it goes up or down, everything's in this one property. But for me, more so is when I sell it, there's a cost for me selling it. Number one, I got time to market and try and sell it at opportune time. But number two, the realtor's going to collect their fees out of that as well. So I'm not capturing all that money. Number one, the realtor fees are going to come out of that. And number two, if it's not my primary residence, there's gonna be capital gains on that as well. Whereas with a REIT, there's no realtor fees. I don't need to qualify for the mortgage, so I don't need to pay higher taxes to get pre-approved or go through that whole process. And number three, if I hold it within a registered account like a TFSA or RRSP, then I don't need to worry about capital gains either. And the same can be said for a MIC. And the MIC is the same kind of idea where instead of you using the bank to give you a mortgage to buy your home, you're an investor inside the bank. And it doesn't necessarily be a bank, it can be like an individual or a B lender, but you can be an investor in that group. And other people will come to you and borrow money. So if they get shut down from the bank for XYZ reason, they can come to, let's say Mike at the Home Happy team, and Mike can have myself and Tyson as investors. Mike can underrate the deal and be like, the bank said no, but we'll say yeah. But instead of 6% interest, we're charging 8% interest, and it's going to be for 1 year, 2 year until you can qualify for the bank again, and then we'll get our part of the investment back out of that, and that can be held in a registered account as well. So my thought process is I really like, again, following the Income Tax Act. So if I can hold something in a registered account and not pay tax on when I eventually sell that investment, I always really like that idea. And for me, I'm like, it's cool that, yeah, you can't leverage like you could with individual real estate, but you can buy a lot more with the same dollars of buying a REIT or a MIC. But I think this plays for everything. So that's my thoughts on it. Tyson, what about you?
What was the question?
What's the difference of real estate versus other investments like a REIT and a MIC? What are your thoughts on it?
Yeah, I think from an investor advisor point of view is we want to look at portfolio diversification. And this is something that Vishal and I bump up against a lot. And Mike, you probably do too, is clients come to you and they have this portfolio of real estate, but it's all the same thing. It's all in the same area. And just because you have, like 19 homes or single family homes, it doesn't necessarily mean that you're diversified. It doesn't give you a lot of flexibility. Whereas if you had a REIT as a sleeve inside your investment portfolio, you have a real estate exposure, and some of the benefits of having, a REIT versus physical real estate is, like Vishal said, they're doing some due diligence for you, but they're also able to scale geographically. So that you might hold, like a mobile home franchise or a park in Texas. Like you're not flying down there to do due diligence to check that stuff out. Nashville's growing, so they're investing in Nashville, and then they're investing in Florida, and they're investing in all of these, other intercontinental and international spaces, so that you can hold that real estate holding, benefit from it, but you don't have to fly there. You don't have to do due diligence. You're not managing it. And then when you sell, it's fairly quick to liquidate. Some of them might have a 60-day hold period. Some of them might have a 90-day hold period, but you can transition out of that fairly quickly. Whereas if you're in a bad market and you want to liquidate a home and offset, and it the market's not good, you might be sitting for a year or 2 or 3, and no one wants to think about the downsides of that kind of stuff. Where we see MICs being used a lot is people who have this kind of like never spend money, that they know they're never going to need this money. It's allocated to the side. It's just for growth. They invest in a MIC. They partner usually with a MIC company, and they're on that 1 or 2 year contract, and they just renew over and over and over again. And they love the dividend. So we've seen a couple of partners out there in the marketplace that they pay a 7, 8, 9% dividend. And who's going to say no to that? It's you're still investing in real estate technically. You're dealing with mortgages, which there's some guarantees and there's some security in that, and then you're getting a great dividend on the back end. The challenge, I think, where a lot of people come in is they don't do any defensive prep up front. So if you need liquidity, these might not be the best 2 options. You might want to look at something else, which is where the rest of your portfolio should come into play, and proper planning and strategy should set you up for success and not lock all your money into one thing.
Yeah, I'll just touch on especially MICs. Mortgage Investment Corps, we use them because they provide private financing for clients. So some of our viewers might not be aware, but I mean, we do a lot of private financing where the mortgage is paying like 8 or 9% interest, or as a second mortgage, it might be 12 or 14%. And I know MICs that have averaged over 20 or 30 years, like 10% or 11%. And like you said, I mean, it's not as liquid. it's usually harder to get out of if you really want to get out of it, but it's a great long-term hold. And you're diversified. Think of if you bought, if you did 2 mortgages and lent people money and did it yourself, if one of those goes into foreclosure, half your portfolio is now in foreclosure. Whereas if you're in a MIC, they've got 50 mortgages out there, or 100 mortgages or more. And it's geographically diversified, but it's also diversified in terms of the risk. It's like one person doesn't pay, it's not going to affect very much. And I mean, diversification is such a, I think it's almost misused, but even in your personal portfolio, if you're going to buy rental properties, why buy them all in the Lower Mainland? It's kind of like, I try to think about, home insurance companies, like they get scared of the Lower Mainland because there's a potential for earthquakes, right? So they charge a risk on that. And you should do the same thing in your thinking, is like, if you're limited in BC with the rules of like 3% increases a year, what about buying in New Brunswick or buying and it gets more complicated and harder, and that's why REITs can be useful, but also it should be thought about for your own rental properties too. It doesn't all have to be here. It could be, I've seen clients that have gone into Edmonton and they have really low vacancy rates in Edmonton. So it can be it's not going to go up in value very much, but it might be great for cash flow. So there's lots of different things to think about there too. So, yeah.
Yeah, well said. And just as we wrap up, sometimes people ask the question, like, where can I even buy REITs? So you can buy them on a lot of platforms like Equestrade, for example. It's pretty easy to find REITs, and a lot of the mix out there, some will be on there, and some you just have to honestly Google, and you can find a lot of them around here, and just take a look at the website, take a look at the prospectuses, and just like Mike said, take a look at the vacancy rates, the foreclosures, and what's the plan for those. Because if you see 6, 7, 8, 9%, you're like, wow, that's fantastic. But there's a lot of risk in those. I've seen some mixed funds that are like, yeah, we pay 10% dividends, and it sounds all great and everyone's excited about it. But when you look at the what if scenarios inside their portfolio, there's not a lot of good options. So if something goes belly up, you're caught a lot into that. So I just want to wrap up on that thought of where can I buy it if it seems interesting to you. Start off with a small amount. As always, do due diligence. Invest in money that you're not scared to lose. If you lose it, it's okay. And just take a look and see what's out there. So there's a bunch of different options. But that being said, we're going to be wrapping up here on our most recent episode of Portfolio Talks. Thank you, Mike. Thank you, Tyson. We'll be back next week. If you haven't already checked it out, we dropped a special episode, I believe it was a week and a half ago, which from our graduate class at UBC of dentistry. They jumped on and talked about how their first year has been of real life adulting and what that looks like, and having to find a place to live, budgeting for starting up your own practice, designed to work in rural versus in the city, and all the decisions that go into that. So great conversation. It's on our YouTube page. If you haven't seen it, make sure you check us out on YouTube, like, subscribe, and of course, any questions you have that you want put into the next episode of Portfolio Talks, drop in the comment section, and we'll try to do our best to throw it into the agenda. So have a great day, everyone.
Awesome. Thank you.
Thanks.